Hey everyone, and welcome to the Bricks, Bucks, and Bytes podcast, your weekly dive into funding, market, and investor news in architecture, engineering, construction, and supply chain. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode.
Good morning, guys.
Good morning. Morning. Morning.
Actually, Patrick, there's some great news from one of your portfolio companies, Speckle, who just raised their Series A. And in fact, in around 40 minutes of us recording this, the episode where we discussed the fundraise will be going live. So,
wow.
Happy
this
days.
Is some Inception level stuff with all the non-linear. No, sorry, that's not Inception. What's the non-linear time movie that came out the other day? I don't know.
It was Inception, I think.
Inception about
similar kind of concept.
Yeah.
Something I don't want to think
too
deep.
We make very non-linear time here on Bricks, Bucks, and Bytes.
Don't ask. Okay, guys. So, mine. How are you? Are you okay in Poland?
Yes, I'm pretty good, thank you.
Good. Okay, so we're going to do something slightly different today. We had some requests from some of our audience about fundraising. And so Patrick has offered to share his wisdom on the subject because as it stands, according to a few people...
Will be a 1-minute episode.
Yeah, guys, this is a quick snapshot. As it stands, fundraising environment is pretty tough, whereas maybe, 3-4 years ago, it was a slightly different picture. So Patrick's going to share screen, and he tells us that he has this magical playbook, which we're going to run through and discuss. So, Patrick,
we're only going to run through page 1, though.
Okay.
Yeah, can't lose all the secrets.
And as always, everything is an execution. I think every founder worth their salt knows that. Yeah, but I think it's a great topic because, as you said, Owen, fundraising used to be very, very easy in 2020 and 2021, and it became very hard late 22, all of 23. For the early stages, it's becoming better again. And we discussed the other day on here and on LinkedIn the Q3 fundraising stats for construction tech. And as you could see, actually, that the seed stages have been growing in size in Constru Tech massively in Q3, but also the whole year. And that's a reflection of what I also anecdotally can confirm is that, the early stage environment, including Series A, actually is quite liquid again. It's not as crazy, not as wild bets as it was in, 3-4 years ago, like you said, but still it's becoming liquid again. Whereas if you're a growth stage company, it can still be a tough environment for you. We're early stage investors. So our, the principles that I'm about to share are universally applicable, but the weighting that you give will be different in a growth stage than compared to an early stage. So everything we're discussing today, I'll put in the context of an early stage. And if you're at a growth stage, you will have to give different weights to the different principles, if that makes sense.
Roger that.
Mm-hmm. So I can just fire up the screen here. And
Patrick, a question before you dive into
and
it.
by
What
the
has
way,
changed?
everyone, if you can, it probably best enjoyed by video this episode.
Yes. Patrick, so what has changed that the fundraising at the early stage is slightly easier than it was in 22, 23?
In general, funds and early stage investors did sit on dry powder that they had raised in late 21, early 22, mid 22. And especially in the US, the investments from that dry powder were pretty much frozen for a year and a half, because US investors in early stage, they have their flaws, but they tend to be sophisticated as well. And as part of that sophistication, because they have gone through prior cycles, down cycles, up cycles, I think they had a very realistic view of hey, the market is going to bottom out at some point, so let's not buy prematurely, but let's find the bottom first, which is something that the European investment community, for example, hadn't done in the same way. And so that, but the US obviously is about 3 times the size in terms of general VC investments of the other 2 markets, right? So Europe and Asia Pacific. And so that's why in the numbers for Construtech, you would have seen a strong, let's say, freeze in 22 and 2023. That dry powder from US investors has become basically thawed and become available again in 2024. Europe was always liquid. It remains exceptionally liquid, exceptionally competitive, actually, in the early stages. And Asia Pacific, again, I think there the investors were just being very, very cautious of not buying at too high valuations, and overall just the number of early stage deals that got done, 18 months ago, 24 months ago was very low, and it's catching up again. So that's that. And then secondly, the second effect is we're seeing just very good founders come on the market now because they seem to have conviction also that the money is there for them to build ambitious projects.
Very good.
Okay.
Yeah. Okay. So just page 1 of what we do. So we're just looking here at several principles. I'm a first principles fan. I like thinking about my own business as well as founders thinking about their own business in the axiomatic way. So if I know what is actually true, if I know what is going to stay true, then I can understand from there and build my own reasoning what I should do for my business. And the same can be said about your fundraise. So we're going to walk through some here, and we can pick each one one by one. So first, you have to understand when you approach fundraising, what it is based on. And the first thing when you're new to this that you might not realize, but you realize it quickly, is that if you seek VC money, you need to have the ambition to go 100x plus with your project, because that is the fund economics that venture capital investors promise to their investors, to their shareholders. VCs at the early stage, again, that's the context, cannot underwrite bets that only have a 10x potential. That doesn't mean that they always hit 100x. In fact, they hit 100x very, very rarely, but they have to have the potential to go there because only very few will actually make it there. Look at power law, but that's the principle behind it.
Mm-hmm. Yeah. Question for then, Patrick. So, it's a bit of a probably a difficult one to answer, actually, a bit meta. But how does a founder know of
how many X?
How are they convicted? Yeah, that their idea will go to 100x. And maybe I can try and explain it a little bit, because I suppose some people are thinking of raising VC money. Maybe they just like the idea of raising VC money, but they don't actually think, oh, you know what, this has the potential to go 100x. Maybe they just think, I want to create a business that's going to bring me in a few million revenue. It'll be a nice lifestyle and I'll enjoy the work and whatnot. And I like to work from, I don't know, Bhutan or wherever it is, and so on and so forth. So can you speak to that? Does it make sense what I'm asking?
Yeah, totally. I mean, look, in the end, it's a function of 3 variables that you have to understand, putting yourself into the shoes of your earliest investors. The first one that you will think of is, okay, what can I sell my firm for? But the second one is actually, what am I selling that VC the shares for today? So my current valuation, and in between, how much dilution should the VC expect? And so the 100x is not exit divided by entry price. It's actually decreased by the dilution that I suffer along the way. That's why hardware intensive plays are not popular with every type of VC out there, right? So when you think of your own 100x potential, take those 3 variables in mind for the earliest investors, and you might actually come to the conclusion that your model just should not take VC. The best metaphor that I have read ever online, and I think it's true, is VC is rocket fuel. Do not spend it on, sorry if I offend anyone, a Fiat 500, okay? Only put very expensive rocket fuel if you're actually building a rocket.
So you're saying that VC money is expensive?
Very, of course. Equity money in general is very expensive. If you can get debt, that has other downsides, but just in terms of what it costs you, it's typically much less expensive.
Interesting. So is it that does it come down to total addressable market when thinking about this 100x, or how
Yeah,
people?
It's one of the factors that I have here in the middle bar. Let me get there in a minute, Martin.
Sure.
But
Okay.
yes, it does. The second principle is that generally VCs in the early stages will move much faster if a deal moves fast. I think every founder knows it, but the principle behind that is optionality. You have to understand, when you give people optionality, they are always likely to use it. Everybody, because of option value. So if you don't take yourself off the market, people will eternally use the optionality to collect more information from you and wait something out, sit something out, etc. But on the other hand, if you are not on the market very long, and that is believable, that is authentic, that is not fake, etc., then you're forcing your potential partners to do a deal with less diligence. So that's something, not everybody will do that, by the way, so that's not 100% correlation, but some of them will have to do a deal with less diligence. So that's the second principle to understand. Now, coming a little bit to the internal workings of a VC, just on the principle side, and then we can move to what it means. So you get fired in a VC firm if you don't know nothing about a company. That's the fireable offense. So if let's use the employed investment team members, because there's just 5 to 10 times more of them than general partners. If you're an employed investor, let's say a principal at a large firm, and you cover a market for that firm, some are geographic, some are topic specific, stage specific, etc. So you cover that market, and then this deal gets done, and your partners catch you in their CRM that you had nothing down on that deal. You didn't meet them, etc. If that happens once too often, you're going to get fired. And that's exactly why these VCs who don't see a deal then very quickly scramble to get in front of a founder in order to appear busy, or in order to, basically when the founder is late in the fundraising process, you will get reach out emails. And it's not because they are actually interested in you. It's because they're interested in keeping their job.
KPIs.
Okay? Then the derivative of that, what happens is that if you don't give them that meeting, they will start calling up their friends. Hey, can you share your notes with me? Blah, blah, in order to put something into their CRM, in order to appear knowledgeable as if they had seen the deal. That's the crap that happens in large VC firms.
I had no idea.
Yeah. Now, another principle here to keep in mind is that VCs lose money when they make too many assumptions. And we have to make a lot of them, right? Because VC is a decision-making business under imperfect information, especially the earlier you invest, which is the context here. There's a ton of things I don't know. There's a ton of things I don't control. And so I will have to make a bunch of assumptions. And the best principle to invest is not to stack assumptions on top of each other, and to avoid those assumptions that I should actually control. So what that means is I don't like making assumptions about the market. I don't like making assumptions about the team. These are two things that I control at the time of my investment. I can get relatively good information on it, and I can then make sure that these factors work for me. About future competition, future regulation, all of these things, I will never have perfect information. So there I will have to accept assumption. But if I stack those assumptions on top of, hey, I'm assuming the team will become good, or I'm assuming that the market will develop that direction, then I'm stacking too many assumptions. And so that's something that for you, if you fundraise, you should keep in mind, right? So make sure that you have excellent references ready for that investor, for example. Make sure that you have described the market in a way that becomes super easily understandable, but also it's easy to have conviction that the market will work in your favor, right? So that's important. So remove any and all assumptions for the VC that you should control.
Question here. Have you broken this rule in the past when you had a founder who is absolutely exceptional in one or two or maybe three things? Maybe there was a repetitive founder and you kind of ignored it, quote unquote, ignored the market or the team or some other. Have you done an exception?
So I wouldn't say we have broken the rule, as in we knew that the founder had certain deficiencies, and it was very unlikely that they could become successful. Not in that sense broken, But what I will say, Martin, VC, so Hannah from Index was on a podcast the other day on EUVC. And so I'm going to quote her. I'm going to steal the quote from her because I really liked it. She said, VC is an apprenticeship business. And she meant it in the context of this is an apprenticeship that never ends. You're constantly going to learn and the apprenticeship is never over. That's why it's an apprenticeship business. And the same I can absolutely say applies to me. And I know it applies to every investor. And so that's the answer to your question is my benchmark of what constitutes a founder that I trust to get the job done and build a big business has become over time higher and higher and higher and higher. And so today, some of the founders that I backed in year one of Fundamental or year two or whatever it was, right? So today, perhaps I wouldn't back anymore. So that in that sense, yes. But at the time, it seemed like a good decision. And it was, it was clearing the bar.
Yeah.
Yeah. So that in general, because of this controlling, the mindset of we want to invest in things that we control and live with the things that we don't control, VCs in the earliest stages rely on three things. They rely on market, they rely on the founder's execution track record, and of course what the team represents today. That's the things that I can really, really gain high quality information on and that I can control by making my decision against those. Everything else is just hope. Let's say for what it is. Everything else is just hope. It's hope that the regulation doesn't move against me. It's hope that whatever the incumbent doesn't get their shit together. Or that, maybe there's not a better team out there that will found in 6 months from now. All of that is hope because I never can have good information on that.
Mm-hmm. Patrick, in terms of speed, obviously it's kind of within everyone's best interest to get a deal done quickly, right? Like one from you because it takes up internal resource and capacity, and also
actually that is not correct.
No, okay, there we go. And I was also going to say from the founder's side, obviously it's a huge distraction when it comes to where they're allocating their resource. Like, should we be building a business or should we be fundraising? I mean, the two come hand in hand, but you have to prioritize, right? So go on.
Yeah,
you was going to say.
So so you've made one implicit assumption, and that is if, what do I optimize my fundraise for? So do I optimize my fundraise for the financial terms, size, valuation, dilution? Do I optimize it for the partner that I want on board and what that partner, stands for or thinks about, what is important to them, etc. I can optimize for speed. I can also optimize for giving as little information into the market as possible. There are different ways how I can optimize. But I think the poorest of them all is where you do not optimize for the partner to bring on board early stage. Growth stage is different. It matters much less. But I think that implicit assumption that you just made, I'm glad you made it because it's a realization that many founders, especially on their first tour, don't have. And on their second tour, it's the number one thing that they optimize for. It's very, very interesting, actually. And the reason why I react to that in terms of speed is,
what about?
So let's move into the middle part with this. I think that was a good segue, Owen. So we've discussed the principles, right? 100x potential. We do less diligence when everything goes quick. We get fired when we don't see the things in our scope. We lose money when we make too many assumptions. And that's why we love, market, team, execution track record, the things that we control. So that means that as a VC, as a founder, now flipping the side, as a founder, what you control is information asymmetry. And that's a mistake that early stage founders make too often is they think that giving away information in between fundraisers works for them. It never does. It does not work for you. In fact, what works for you is information asymmetry because it will make the VC move. The VC, because they need to have information about making good decisions and they get fired if they don't see you or see what's going on. They will stand at your door 24/7 as long as you don't give them information. It's complete counterintuitive, but that's very important. Now, you can overplay this, right? So you can play it too cute. You can play FOMO game. Don't do that. Don't do any of that, but you can still have information asymmetry and be a reliable partner if you play it the mature way. So for example, hey, I'm happy to meet you for coffee. Love to get to know you as a person. Tell you more about my team, all the things that someone could Google or someone could not copy. That is completely fine, but there's absolutely no reason to give them details about your product, your traction, your go-to-market strategy, etc., in between fundraisers. During the fundraise, absolutely, I need that information to make a decision. In between, there's no reason to do it. Keep the information asymmetry up. That's important.
So,
Patrick,
would investors like request this? Perhaps. I suppose there's maybe I'm thinking about this. You've got investors that have already invested in you that are asking for information in between the fundraisers. That's acceptable.
Oh, my existing this doesn't apply to existing shareholders. So existing shareholders are your partners. I'm glad you asked this. I've also seen this mistake once or twice. Fortunately, it doesn't happen too often. But when you keep the information asymmetry with your existing shareholders, that is a very dumb mistake to do, because your existing shareholders are the first signal investors that every outside investor will look to. What will they do? And if they don't have the information to come to a high quality and high conviction decision, they will not cheerlead for you, and they will be hesitant. And that action speaks very loudly to the external market. So the first shareholders that you need to excite for your next fundraise are already on your cap table. Never forget that.
Roger that. And so in between fundraisers, then you may have an investor which is not on the cap table, but is requesting information. So your advice is basically you shouldn't give it to them, or you don't have to give it to them.
You can give them information that is Googleable or that is not copyable. Like I said, right? Excite them about the team, excite them about perhaps, how you see the market. Absolutely no reason to give them specifics about your product, your traction, go-to-market strategy. None of that.
And so the benefit of doing that is that VCs will be more interested in you. Is that what you're saying?
So that's not necessarily interested in you, but they will be interested in keeping a relationship towards the next fundraise, and be on day one, the moment you want to schedule for the fundraise, be there. That's what's happening. It doesn't increase your odds of them making an offer, but it does increase their odds of reacting to your email ASAP and setting a meeting ASAP. And that in turn increases your odds of having a structured fundraise.
Hey, Martin, it all makes sense now when we ask people on Bricks and Bytes how many users they have, and they won't share the information.
But also very interesting, because we often speak with on the podcast when there's two co-founders, CEO and CTO, and they would say the CTO is obviously within technical sphere of the business, and the CEO would say always talking to investors. Like that's the kind of quote I'm just quoting, always talking to investors, which is actually not unless they are speaking to existing investors, that's not actually the best way of approaching their job, right?
So for growth stage, you should always be talking to investors. For early stage, I think it's a mistake. However, for early stage, if you build something that not a lot of investors will have comfort with, prior experience with, let's say on-site robotics for construction, that rule is better served if you do actually build relationships with the investors. Again, keeping up the information asymmetry though. It does not help you if you give them the ungoogleable information. Just give them comfort on the things that they need comfort on first. That is you as a team, your track record, how are you hiring, what is your market like? I can Google all that, but if I get it from you, I get to build a relationship. And that obviously goes a long way in building my conviction.
Remind us briefly, what's the difference between a growth stage and early stage? Is it any very distinctive thing that people can learn?
No, it's not super distinctive, and it will depend on the model, right? So some companies reach, in a marketplace growth stage, let's say 150 million annualized GMV, for example. In a SaaS company, it might be 10 million ARR. Whereas in a robotics company, it might be at 0 ARR, but the amount of product that you have built and the quality of the team and the size of the team that you have built. But in general, just as a rule of thumb, if you're past 30 million funds raised, there is a likelihood that you will be considered early growth stage.
Sorry.
Gesundheit, Martin.
Sorry, thank you.
Yes. Also from the principles, make sure that you're working in a market that has a huge potential, because this will make VCs prop their ears up. However, I can tell here also, the mistake that founders do is they don't communicate a huge market potential in a uniform market. Oftentimes they will just use a number pulled out of a hat and that market is not uniform. I'm not interested in ununiform markets. That number doesn't help me because I cannot address a non-uniform market with the same product or the same go-to-market motion. You need to communicate to me how a market is huge that I can address with my product repeatably and my go-to-market motion repeatably. And so it's much better to have a uniform market at 5 billion than to have a non-uniform market at 500 billion.
What is the definition of these uniform and ununiform market?
I mean, it's my own terminology. But so again, it means that I can use the exact same product and the exact same go-to-market motion to address customers and keep selling. The moment I need to adjust my product or adjust my motion, it's not a uniform market anymore. Yeah, then it's market expansion. And that's something that you can communicate to me and you can tell me, hey, I think I'm unlocking the market expansion later down the line because I do this and then I add that. That's also fine, but it's much better if you show me a huge market potential on a uniform market.
Mm-hmm.
Okay. Social validation.
I will also say, I think, don't get hung up over this too much. I personally prefer founders that have $1 billion niche initially that they can address as the only player and they can grab market share, and that unlocks the market expansion. So that makes a lot of sense. But what absolutely does not make sense is don't tell me you're addressing a 500 billion building materials market. That's just bullshit.
Mm-hmm. Mm-hmm. Yeah, owning the niche is the king.
Yeah. So whatever is huge could depend on your context. Yeah. Then third thing that you control as a founder. So the first two was keep the information asymmetry, demonstrate a huge uniform market potential. The third one is you can let the social validation game play for you because VCs, unfortunately, are relatively dumb creatures that will trust curation from other people more than their own judgment. For many, many people, that will be true. The good investors, that will not be true, but many, it will be true. And the logic that happens then in their brain is, multiple people that I think highly of are looking at this deal. And so then they want to look at the deal more, and then they will chatter more about you, and it becomes this, not truly viral, but it becomes this word of mouth kind of function in the background while you do your fundraise. And that absolutely, there's no downside to it. There's only upside as long as you make sure that not every of your company secrets is spilled over in the market. So that would be a downside, but that's up to you as a founder to make sure that doesn't happen.
Question here is this social validation works on the general partners or only on the junior associates within the VC firms?
It's a great question, Martin. It works a lot on the employed investors. It works a lot on the less senior colleagues. It does work on the senior people too, usually, except for the great ones. And it's just that the bar for social validation becomes higher the more experience you get. Imagine, Elon Musk shows a deal to a senior partner at Founders Fund. What do you think happens?
Mm-hmm.
That person will not turn down a meeting. Absolutely not.
Mm-hmm.
Triggered.
Okay.
Rockstar team.
Yeah, so that's another thing that you control. You cannot fill your team with too many rock stars. It's impossible. And if you have the ability to hire.
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
Absolutely exceptional talent. Your next fundraise will get done. It will get done.
Mm-hmm.
It might not get done at the terms that you like if the other factors are not in place, but you will always get more money. If you then lack execution, at some point it will not be enough anymore, but in the early stages, it will always get done. And you control this. Your ability to attract an A+ CTO or any other role that you need to fill, that's in your control. And the reason why this is because it gives VCs security that there's more excellence for execution, but most importantly also, the truly exceptional talent will do more diligence than the VC. because the truly exceptional talent has more to lose. They have to lose their lifetime and not, someone else's money, like the VC. So that's why the truly exceptional talent will typically take their sweet time of diligencing. The really great hires that my portfolio companies have made, they took 6 months. And that's because 3 months of those were diligence by that exceptional talent, right? Mm-hmm. So that's something you control as a founder. And I think especially first-time founders, they prioritize hiring average people in order to get something done or quickly fill a team and et cetera, et cetera. It's a much better way to take an extra 6 months if you think you can get that truly exceptional person.
Do Rockstar teams fail as well, or it never happened in the history?
You will get very different answers on this because the definition of Rockstar here is super context specific and super. There's a taste that the investor ideally acquires, and investors will have different tastes to this. So, for example, some people might consider 3 people with 3 years of experience at a large venture-backed startup and previously worked at BCG or McKinsey, a Rockstar team. I personally would not, but some would, based on paper, just based on backgrounds, right? Whereas I would consider a Rockstar someone that has actually studied physics, worked a couple years at Palantir, knows I don't know how many software languages, led an 80-person engineering team, didn't even finish their physics degree, by the way, to build a robotics company. For me, that's pretty Rockstar. But it depends on the context and your personal taste a little bit.
I wanted to actually make a reference to this when we were speaking with Wouter Gord. I think I'm not butchering his name too much. Who is an investor in Monumental, right? That we interviewed in Amsterdam a few months ago. He said that no matter what, sorry guys, remind me his name.
Salar.
Well, Wouter said, no matter what Salar does, I will go with him and I'll invest in whatever he does.
Yeah, exactly.
Also,
and then
on the Salar reference, there's also a cool story which from the series that we've done with them about how Wouter found him in the street not in the street, but in a building on a street in Amsterdam with Meccano and about 60 bottles of Pellegrino screwed across the floor because he was working out how to make a robotic arm. And he was like, this is why I love you.
Nice. So, and that's right. So every investor might have a different taste of what is Rockstar. So there's absolutely no point in you trying to gauge the system. Hey, these are the logos that I need to hire. Just you as a founder, figure out who is the absolute best person for the job and can I get it? Because if it's truly the best person, then some investor will get that too.
Okay.
We discussed that speed makes VCs do less diligence. So they will then focus on the big items. But on the other hand, conversely, if you give them optionality, for example, you give them information in between fundraisers that they don't need, they will use that optionality against you. Because at that time, they are not in the same boat as you. They want to get in the same boat. But before that, they have to optimize for what's important for them. And you have to optimize for what's important to you. Do not give them optionality. Free optionality is bad. And then finally, something from, stolen here from Jerry Jones, owner of the Dallas Cowboys. But, as flawed as that person is, that person has one thing right. And that is the quote, deadlines get deals done. Nail that above your bed, wake up in the morning, look at it. It's a universal principle in life. I can absolutely confirm deadlines get deals done because they remove optionality from the table. And that's another big mistake that especially first-time founders I've seen do is when your fundraise doesn't go the way you like it, you cannot keep going. It will not help. It will not work for you. 99 out of 100 times, you will not get a fundraise done after that either because of the social chatter and whatnot, or something is just fundamentally flawed. You need to take yourself off the market. You need to find other ways to keep the lights on. If you need the money, or you need to just basically say, hey, right now, if I have enough cash, just let's stop the fundraise. Let's keep building and go back into the market in 6 to 12 months with improvements on what kept us from actually raising the round. Now, do not stay on the market for too long. Always take yourself off the market if someone doesn't buy it, because the VCs will use the optionality against you.
What's the typical length of the fundraising? And what's the optimal? What's the best?
Depends very much on the stage, the model, the year we're in, etc. But to give you maybe one flavor, so a seed round in 2022 in Europe took, for the good companies, 4 weeks. A seed round in 2024 in Europe for the good companies takes 2 weeks.
Very fast.
That's a seed round. The growth rounds in Asia in 22 and 23 took months and months and months and months. Also because Asian founders keep doing the mistake of not taking themselves off the market. I see that mistake being done in Asia more than in the other continents.
Which is
The
constantly
growth
raising,
round
right? Not taking yourself off the market means constantly raising or talking to investors. That's
basically keeping the exact same process open. So constantly raising, as in I always am open for money and getting preemption, etc. In my opinion, that's also a mistake, but it's a different one. But if you try to raise the exact same round for too long, that's what I mean by not taking yourself off the market. Yeah. Seed rounds in the US right now get done for good and for average companies in our space very quickly too. It takes 3 weeks or something.
Nice. Patrick, of these things you control, is there, again, probably a meta question, but is there like a weighting criteria where you might say like, oh, they have a really strong team, but maybe the market potential is questionable? Would you then say, yeah, it's still worth flying with?
I would always pick team over market, always. I would not pick a market with a team that I don't have maximum conviction in. I will not do that. It will very rarely work out, but occasionally it will work out, because sometimes you have these niches where even after 10 years, no competitor pops up and you had so much time figuring things out that a good but not great team could still build a fantastic company. But from the VC mindset, I control the first thing that I control is picking the team. Because the team, if it's great enough, they can figure things out. If I don't optimize my whole decision around that thing that I control is picking the team, I'm already much, much less likely that my decision eventually will return the expectation that I have.
Which one of those first principles you see founders in construction tech don't pay enough attention to the most?
Probably the uniformity of the market. Many construction tech founders are really poor at communicating the market and the uniformity of it. So the 500 billion building materials joke that I gave earlier, I wish it was only a joke, but I must get that pitch like 50 times a year. You can show me the large potential, but I need to know how you execute right now on a uniform market. And if that uniform market is already big enough, it makes my conviction already very high.
So you need to be specific, exact, rather than just broad.
Very, and always keep in mind, uniformity is defined as same repeatable product with same repeatable motion. That's how I address a uniform market. If I have to change one of the two, it's not uniform.
Very good. Do we go to the third column?
Yeah. So we just covered, based on the principles, what we control. Information asymmetry, communicate a huge uniform market, make sure that there's social validation happening left and right, build a Rockstar team, make sure that you get speed into your process as much as you like, while it still allows you to get to know the perfect partner that you like, and take yourself off the market. Deadlines, get deals done. That's what you control. Ideally, something that you do not control during your fundraise anymore, but something that you would have had to build before, is you need strong execution. Ideally, and again, you don't control it, the market that you attack is wide open. No tech-enabled competition. No VC is ever scared of incumbents. And if they are not worth their salt. So nobody cares about the incumbents. But ideally, you have no tech-enabled competition. And if you can demonstrate successful good analogies from other markets. It helps the VC quicker build empathy for what you're trying to do. But here I would just say, try not to limit yourself to the analogy. You're trying to be your own generational company. That's what VCs invest in. And so try to demonstrate how you're unique, how your ingredients are unique. But there's certain validation of certain aspects of us in analogies from other markets. So that certainly helps the VC. So you should have strong execution, wide open market, and if you can, successful analogies without limiting yourself to them.
On your comment that no VC is scared of incumbents, is it because you can't control them, or the nature of incumbent is not the nature of a startup? So that means that they can't move as fast as startup, and they probably will be replaced sooner or later.
Yeah, it's if the incumbent could innovate faster, move faster, grow faster than a startup, we would be investing in public stocks. So it's a fundamental principle of VC that you actually believe that you can grow a company quicker by building a new firm and being run basically by the owners.
Yeah. Okay.
So what we've done is then we've codified this into just back of the napkin fundraising formula. Sorry?
We're getting into the second page.
And there's still
no,
one
it's
page.
Still the first page. Still the first page.
Okay.
But just I think it's a very catchy formula that you can keep in mind. By the way, I don't know who added an R here. Hold on. Sorry, I can't.
I thought it was in German.
There you go.
Yeah.
No. There you go.
I feel it's a VC word.
We have many of those, but formular is not one of the formula. So try to maximize potential times validation times a forced decision. Potential times validation times forced decision. So if you can communicate to VCs that there is a huge uniform market and no tech-enabled competition, and that's the times validation, comes with social curation from highly reputed other angels, other founders. It comes with validation from your team's track record, how your team communicates, what your team has built since the last fundraise. And then there are successful analogies and a very strong execution to date. That's the validation portion. So if you have this potential times validation, that's already great. And now force a decision. Create information asymmetry, create speed, and create deadlines. So potential times validation times forced decision. That's a successful fundraise.
Mm-hmm. I have a feeling that these principles are like negotiation techniques or tactics or persuasion tactics in general, but very specified into like specifically applied to what you guys do.
I certainly hope so. I would definitely do. That's the beautiful thing about fundraising for VC and especially for early stage. It's a highly transparent process for the founders. Even though founders will say, "Hey, VCs, they rarely tell me what they really think." Oh, in the grand scheme of things, it's a very structured and very transparent process for founders. And that means you can also be structured about going about it, right? And so this formula encapsulates how it works. Potential times validation times a forced decision.
Very good. Anything else to cover on this?
Maybe what's not in here, don't play the FOMO game. It turns almost every investor off. And the ones that will not be turned off, I would guarantee you more than 50% are the ones that you don't want as partners.
Can you give an example of FOMO behavior when fundraising? Just getting
very poor one. The good investor, the good founders that will try to play FOMO will do it much more elegantly. But the crude poor one is a founder name dropping other investors that they are talking to. Bro, I have friends on every investment firm. Okay, I can just call them. I'm not, because I don't care about what they think. That's me personally. But if you wanted me to, that's what I can do. And actually, here's a real anecdote on this one from this year, from our deal flow. So we had a firm that was building a new type of B2B marketplace. They were showing relatively impressive numbers for their first round of funding. So we naturally, looked at it. The founders came from pedigreed tech-enabled companies and marketplaces where they would have learned skills that translated into this business. So that made us look as well. So we went through the motions. We looked at the fundraise, and at some point the founder revealed to us, unfortunately, that he's a liar, because he tried to play the FOMO game and said, hey, by the way, this and this investor is short of issuing a term sheet. Well, unfortunately, my partner is very good friends with the founder of that firm. And we asked him, hey, can we reference check with you, with them? Is that okay for you? And then he said, I'm not so sure, if at all. So that then raises flags. So if you actually come up with the name and then you tell me, hey, I can't talk to them, which I, out of respect for you, will do. I will ask you, hey, are you comfortable if I now talk to them? And if they say no, that's then a bit weird. So we passed then blah, 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 blah. Months later, it came out that investor, that founder of that firm, had never even heard of the company. Not only did he not talk to them, had never even heard of that company, right? So in hindsight, it got confirmed, why we passed basically was for other reasons, but it got confirmed. We also dodged a bullet on a massive liar. And so that's a very crude way of playing FOMO. Sophisticated investors will not fall for it, luckily. The more, let's say, nuanced FOMO game can be founders that basically try to set artificial deadlines on you, and truly artificial, right? So it's like, hey, I know I've only been fundraising since yesterday, but I need a decision from you tomorrow, because we're so competitive in this process, and I expect term sheets tomorrow after 48 hours. I mean, no kidding. That stuff did happen in 2021 a lot, but it's not going to move me, because that is just going to increase my likelihood of doing a shit deal.
I think that this stuff will only ever end badly, right? Because even if you do get the deal over the line, there's always retrospect. And then you feel like in a long-term partnership and relationship with this person, they're like, hey, you guys never told me about this. And it's like, well, yeah,
exactly.
It was quick.
And that's what I've been saying. So I don't think it's in the interest of the founder either. You want to make sure you're actually meeting your future partners, getting to know them, getting to understand them, etc. And tell me how a 48 or 72-hour process is going to do that for you. It's not.
But still, like examples you mentioned about how long these fundraising last, it's like 2 weeks, 3 weeks, something like that. That's super, super quick, I think.
Yeah.
To get the communication both ways. And that's super quick, I think.
It is, but it's still 10 times more than if you try to do it in 2 days. In 3 weeks, at least, I can get a relatively good 360-degree view of a founder and the founder of me, because we tend to do a lot of references, and I offer a lot of references to the founders that want to work with me. And so if they put in the work, they will actually have a relatively good 360-degree view of who I am as a person, based on what the founders that I've worked with previously give them as an experience.
So to give me a little bit more context on this. So if the fundraising lasts 2 weeks or 3 weeks, would it happen that you already, or investors already spoke with this founder team before the time starts, or they just meet for the first time and start chatting? And because I think the relationship building is something you can't speed it up really. But maybe I'm wrong.
Both happens in every fundraise. So you will have investors that you know from days past. It could be, for example, because they were your previous investors, right? So that can happen too. But also because perhaps you have met them for a coffee, you've played the information asymmetry correct, but still you shared with them, how do you think about the world? What have you done in the past? Who are you looking to bring on as a team? How do you think about your market? All of that doesn't factor into information asymmetry. You're not doing a mistake by sharing any of these in between the fundraisers or ahead of fundraisers with investors. And that way, like you say, Martin, actually get to build a relationship with investors. So that is a good way of doing it. But when you meet them, don't share the things that they don't have to know right now.
What's one of the fundamentals mantras is truth plus transparency equals trust. I'll never forget that from you guys when we done the super series review. So cool, guys. Shall we wrap up?
Sounds good.
Thank you, Patrick, for sharing that. Very insightful.